Sonny, I'm trying to share my screen here. Can you set me as a co-host?
You should be able to. You're a co-host already.
There's no option here. Let me see.
It says you're a co-host.
Everyone knows the phrase, the house always wins. Nobody stops to ask why. It isn't luck, it isn't rigging, it's math running in one direction over enough repetitions without emotion. Same reason the bank always wins. Einstein supposedly called compound interest the eighth wonder of the world. He said, he who understands it earns it. He who doesn't pays it. Most people are on the paying side and don't know the mechanics. So here's the mechanic. It's called amortization. When a family buys a home on a seller finance note, every payment splits in two. Part of it pays interest, part of it pays down principal. In the early years, most of that payment is interest. That's why year one of a 30-year mortgage barely moves the balance. But every single month, the split shifts. A little less interest, a little more principal. The balance drops, which lowers the interest, which pays down more principal and compounds in the borrower's favor automatically. Here's the part almost nobody realizes. The note holder isn't hoping for appreciation. They aren't guessing about the market. They know the exact amount arriving on the first, and they knew it before the first payment was ever made. 240 payments calculated in advance. The casino doesn't gamble, it hosts the game. The bank doesn't speculate, it writes the terms. That's the whole difference. You can't beat the house, but nobody said you couldn't buy one. Learn the mechanics every week, no hype.
A promissory note. It dictates the terms. First lien, fixed rate, and a monthly payment that will follow you for the next 30 years.
Welcome back to the Mobile Mailbox Money Mastermind. We're here today with the Family Bank, providing investors a back office view into what we do on a day-to-day basis. I'm Alden Guajardo, president of Silvercrest Opportunity Fund, founder of Mobile Mailbox Money, and vice president of Win Mobile Homes, here today with my cohorts, providing you a little bit more transparency and hopefully fulfilling trust out in the market. Sonny, maybe if you could just introduce yourself for the viewers that don't know you.
Sure. I'm Sonny Finkel, and I am the investor relations specialist for Mobile Mailbox Money as well as Silvercrest Opportunity Fund. I am also the loan compliance coordinator for Win Mobile Homes. I help the sales agents usher their transactions to the closing table and help the investors get a preview into the notes that are coming into our inventory. I'm also operating the chat today, so if you have any questions, feel free to put them in the chat and I will bring them to the group. If it's something individual, you're welcome to send me a private message and I will help you get an answer.
Sonny, what's one new question maybe that someone's asked you recently? Maybe we could just talk about it briefly.
I mean, it seems like now everybody is self-directing their IRA. Every investor that I have right now is using their funds from their IRA to buy notes. And with all the great information we got from Nate at Directed and our experience in doing that, if you have an IRA and you are not self-directing your funds into notes, you are missing the boat.
So we do have tremendous outreach from individuals, wanting to get a little bit more intimate understanding of what that looks like. Directed is a formal sponsor here at Mobile Mailbox Money, and they're on our sponsorship page now. So there is a discount provided. I think it's called Mailbox Money as the identifying discount code. So check that out on our website. In addition, I've got Sean Gibson here today. Sean looks like he's out in the field.
Yes. Hey, everyone. My name is Sean Gibson. Hope it's not too echoey here. I'm at one of our locations. I was in with Mobile Mailbox Money and Win Mobile Homes. I am a note specialist, but also like to call myself an investor as well, and a jack of all trades. Anything the company needs, just call Sean. I'm always available for any of our investors or our company looking at deals. We have got one right now that we're rehabbing. So always out in the field.
Sean, what property are you at right now?
I'm at lot 155 here in Paradise Groves. It looks amazing. Yeah, you guys did a always great job. Custom cabinets, granite. Yeah, it's just, yeah, it looks unbelievable. Fantastic work.
Sean actually brought that acquisition to me from another broker. So we bought that home from another broker at a cash price negotiation. I think we paid like $15K for that property. We put probably $40,000 into it with lot rent, carry costs, and things of that nature. And it's currently for sale, I think at $85,000. So we stand to make about a $25,000 margin. But the want at the end of the day is to really get to the note, get to the passive payment provided by a seller finance transaction. We do all this work at the end of the day, finding properties, rehabbing them to quality criteria, and exiting seller finance to get to the payment. It's all for the want of a passive investment strategy and in performing notes. So today, we're going to actually talk a little bit in depth about how we do so, how we find properties. Maybe there's some other operators in here across the nation in Florida, Texas, California, Nevada. We're getting a good amount of outreach from individuals from our online presence that are operating in other markets and are looking to maybe replicate what we're doing or really join the team. So we're starting to branch out now, especially to the Florida market. But let's kind of dive in here on how we've become the bank, quite literally, in manufactured housing. I gave this presentation to Arizona Real Estate Investors Association in their creative finance class. So let's kind of dive in the specifics. We're going to kind of set the landscape a little bit, let you know on why manufactured housing is such a big need, but also a caveat in the hardship given a real estate investment strategy and cash flow. You can't just go buy a single family property and cash flow a property anymore. In manufactured housing, we found that availability is abundant across the nation, not only here in Arizona, but also Florida, Texas, California, Nevada. So we'll set the landscape here. Here in Arizona, the housing crisis creates a structural opportunity. Why is that? Well, with median home prices at $450,000, mortgage rates at around 6.5%, and average monthly principal and interest payments being about $2,700 to $3,000 plus, it's actually a little bit more than that. That creates the opportunity for alternative housing given the crisis. There's 65,000 unit less of potential to fulfill units. That's the shortage, and a migration of individuals moving here to the state opposed to not being a move to market. So markets that fit these benchmarks ultimately will be a haven for us to open operations. The middle has quite literally disappeared. It's becoming ever a widening gap from the high net worth individuals to people really just trying to get by. And most people are too qualified to rent forever, but not qualified enough for conventional financing and average purchase prices. Average credit scores for individuals are 6 to 650. At the end of the day, not everyone has exemplary credit, but where's the opportunity to fulfill and turn them into a product that'll ultimately pay us above average returns? Well, that's in manufactured housing. It's the most affordable path to ownership in the nation. Everyone talks about boxable or building ADUs. There's literally no scale in a lot of that because the cities aren't allowing permits to get those properties placed when 10% of housing in the entire nation is existing manufactured housing. And really everyone puts their nose up at it when it's the most viable solution for converting individuals into home ownership. So the national occupancy rate given the Bureau of Census and Housing Q1 in 2026 was 94%. So 94% occupancy around the nation. the cumulative appreciation since 2024. How many people think manufactured housing always depreciates? Well, you know, there's data that supports an alternative at the end of the day. I heard a fact that since year 2000, I believe that was the year that manufactured housing is out appreciated single family properties. It's a new day and age for housing, people. So, you know, don't care what other people have to say. Yes, it is very market contingent, but we know the market well, and the data facilitates what we're portraying here. There's 22 million Americans that live in manufactured housing across the nation, and quite literally maybe 2 financing companies that we've converted with in the nation. You know, you can get a mortgage on a single family property. You could probably throw a rock in any direction and find 10 different lenders. Why is that not the case for manufactured housing? The one major lender in the ecosystem that we've converted with on a few different occasions is Warren Buffett. Warren Buffett owns 21st Mortgage, Clayton, and Cavco. He'll manufacture the unit. He'll mortgage the unit, right? Provide financing via a promissory note, and then securitize that asset with Vanderbilt Mortgage. So a full ecosystem in manufactured housing that he has created. If the Oracle of Omaha says literally we have no interest in selling any of our manufactured housing business, we like the economics, you think you're smarter than Warren Buffett? At the end of the day, we're following in the coattails of an institutional investment strategy with one of the most prolific investors in the world. Everyone follows Warren Buffett's stock trades, you know, and ultimately follows right behind that and does their own trades. This is it. This is in manufactured housing. They're showing you via capital investment where the opportunity is in the nation. In addition, he also just bought Taylor Morrison, which is a large home builder. So he sees the need. He's taking a huge bite to solve the problem and is getting paid in spades at the end of the day. The market data validates this as quite literally a generational opportunity. The recession resistance of providing affordable housing is ultimately fulfilling into a top performing real estate asset. And through market downturns, you know, where do people go when housing gets too expensive? They go into affordable housing. When people are losing their houses and find high rental costs and still inflated residential real estate pricing, and pricing may be coming down a little bit, you know, depending on who you talk to, where are they going to go? Where's the last frontier of human need in the nation? It's manufactured housing. The affordability gap with manufactured homes, it's literally 50% of the price point, actually more like 25% that they spend. They spend a quarter of what they were going to spend in a single family property, and they may not have ever even been provided the option to qualify for a single family home. They're getting literally 20 years of a head start on becoming a homeowner. The average age of a first-time home buyer right now is literally over 40. That's across the nation. Over 40 years old. So where's the next 20 years of individuals? Are they just going to go and rent for the rest of their lives until they hit that average first-time home buyer equation? You know, what is that? And with a constraint on inventory, you know, especially here in Arizona, you can't just go develop more mobile home parks. You got to like know the mayor's daughter or his son or be in the family to get preferential treatment to develop more mobile home parks here in the valley. That means there's a finite amount of inventory. You can't just go place 50 mobile homes off major cross streets of the 101 and 202. It's non-existent of an opportunity, whereas there's existing units already in the valley placed off major metropolitan areas that is available to capitalize on. So what do we actually buy? You know, what's a purchase price? How does that boil down to value in a seller finance note. Well, these are existing manufactured homes. They've been in their current place probably for 40 years, never moved. It's probably been sold once or twice throughout that time. Average occupancy of these individuals is approaching 15 to 20 years. And that's the homes that we're buying that are in dilapidated condition with already existing city utilities in a desirable area where where rental rates, average rent is anywhere from $1,750 to $2,500 a month, depending on the area. So we buy properties from $500 all the way up to like $80,000, depending on beds and baths, what kind of values in the area and what kind of rehab is needed on that property. With a rehab budget of around what we're buying it for, depending on if it's needing major rehab or ultimately needing just minor aesthetics and checking all utilities, we're trying to double our money at any given time. We net a 30% on every transaction when we flip that house and paper the asset and ride the long-term payment. So say our all-in basis is like 40 to 75,000, and we're selling that house from 75 to 99,000 to a buyer borrower who matches or beats market rent. Our source of inventory, how do we find homes out in the market at scale? Well, park-owned inventory is one. A lot of communities have a vast amount of rentals. Park-owned homes, not tenant-owned homes, is an opportunity when those rental leases come due to approach the community. Could be 3 or 4 at a time, could be 1 at a time, just kind of depends. Direct relationships, you could go drive parks, find for sale by owners, and park managers, talking to the managers of any individuals that are behind on rent, going behind on payments, recently inherited a house. There's a problem, and your capital can provide a solution to that issue. We are trying to pivot more here in the local market to all age communities because that's the vast majority of our buyer borrower market. But as we approach the Florida market, as we're trying to expand to the Florida, Texas, California, and Nevada markets, much higher demand for a 55 and older environment. So, talking to park managers, talking to local dealers, maybe throwing a mailer platform in your repertoire, your weaponry, ultimately to get more leads to the table, to find deals, to rehab and seller finance on the platform. It's not as daunting as you would think. We started by just driving parks and looking at for sale by owners, and now we're the largest dealer of manufactured housing in Arizona. So what does a live deal even look like? Why are we all here, at the end of the day as a note investment strategy in combination with manufactured housing? Well, here's the real numbers of notes that get absorbed into Silvercrest on the totals of acquisition costs, rehab cost and carry, plus your lot rent as well as interest. Most people don't factor in how long it's going to take to actually do a transaction, and that could really bite you in the butt. We price in that if we're gonna hold a home for over a year, that's what we price it in at the end of the day. If we had to hold this house for a year, are we still gonna make money at the end of the day? Because cycles come around. The weather gets bad. It's pretty hot here. We're still doing transactions in the summer, but obviously things are gonna sell that much easier or at a higher price point in the better weather. So as we acquire, say, this home at $18,000, we put $30,000 into it and have a $5,700 carry and lot rent cost, and we exit that property. Say we had another $10,000 on top of this, because this is only calculated at 3 months. Say it was $65,000 that we had all in. We had $5,000, $6,000 in closing fees. So that total all in basis is about $62,000 that we exit and resell at $95,000, taking a 10% down payment, maybe a little bit more, with $2,000 prepaid taxes and insurance at closing, and finance the balance. Say they put $12,000 down, just for instance, at the amount of $83,000. So let me put it this way. If you bought a rental that was $83,000 and you were making $1,080 a month, would you deem that a successful investment strategy, depending on how it was packaged and what the performance looks like? That far beats any 1% rule on any single family property in the entire nation. Your 1% rule just became more gold in your pocket at the end of the day. In addition, outside of a rental strategy, you have no maintenance, management, insurance, and taxes. And the buyer borrower is paying $1,950 a month. What is rent here in the Valley? $2,000 a month. So if this buyer got qualified for the loan, got qualified through the community, and matches or beats market rent, and the other exterior housing availability in the area facilitates their non-availability to match or beat this payment, that's where success is had at the end of the day. And that could be had in these other markets. That's literally over $10,000 a year in passive cash flow with no calls, no property manager calling you because the AC's done or they clogged the toilet on Christmas, and what does the equity buffer look like? How do we mitigate risk or ultimately create value given, say, $100,000 mobile home? Well, we have a $40,000 potential buffer of 40% within that transaction when we originate the note, because our profit on the transaction and the down payment potentially received from the buyer borrower, there's cushion when you create the note. So depending on your risk factor, how comfortable you are in your shoes in niche market operations, that provides you an avenue to package that note and potentially pull all your money out and still cash flow that property or sell that whole note position and capture your buffer, capture your 40% in equity on the property. We're netting about 30, after all expenses, taxes, insurance, the labor cost, material, your commissions to the sales agent. And even if the market drops, we still feel comfortable. Why? Because matching or beating market rent is really the goal for that total payment. So this is the power of buying right. You can do all this great work and still, get raked over the coals at the end of the day. The money you make is in the buy. So how do we buy properties at a deeply distressed price point, going through these avenues? As we exit these properties, remember, we do all of this work in order to get to the passive payment. And how do we package a risk mitigated asset to have it be investable by an investor that may even be on this meeting? Well, case specific to manufactured housing, they actually go through 2 rounds of underwriting. I heard an individual the other day frowning on the kind of underwriting that's gone through this platform. And it's kind of interesting because he said it in a joking manner, but he was actually validating the fact that they're going through formal underwritten processes. And the community does have to work. That's in tandem with our risk mitigation together with a leased land institutional operator, $500 million businesses that are putting in their check marks. And then we come in the back with another financial structure to make sure that they can perform on the payment. So for one, most parks, their criteria are a 600 plus credit score, no past criminal. So they have to be an upstanding citizen. In single family, you could buy a single family property and have a felony or be, have an aggressive criminal background. At the end of the day, no open bankruptcy, verified income or ITIN number, and a community stability check. So they're checking the overall financial well-being to make sure when this homeowner moves into the park that they're going to either stay there long-term or have the finances to be able to exit or pivot or whatever it may be if hardship were to come. And as they go through that process, that's a third party. They're not in our company or in our ecosystem. They're a separate entity running through those check marks, right? So they're almost doing like a skip trace where they're making sure that there's no open litigation and things of that nature. Now, the second round is for the finances. So we have another third-party underwriting component in the background. Shout out to Russ O'Donnell, who used to own Call the Underwriter. Call the Underwriter is actually owned now by Dan Deppen. And if you need underwriting, you can call Dan. Maybe in one of these specific markets. I know he's actually licensed in the Florida area. And that's how you continually validate the buyer's ability to repay, ATR. So through the second round of underwriting, now we're getting additional proof of income, checking their bank statements reviews, likely have 2 years of tax returns and a 10% minimum down payment, and get their ability to repay through Dodd-Frank compliance. Sometimes through Dodd-Frank, because of the specific type of income that they're making, they may not hit that benchmark. And then we take it into another review in order to establish, really, does this make sense or not? So the down payment is everything, you know, having sufficient down payment to have them have a psychological ownership, match or beat market rent, go through 2 rounds of underwriting is the goal on all of these assets. So what are the terms? You know, depending on usury, given your local state legislature and federal guidelines, it varies from state to state. In Arizona, most people don't know, even a lot of experts that preach they know everything about notes and usury and compliance and things of that nature. In Arizona, it's prime plus a few unless otherwise agreed upon. What other states actually have a usury like that? Well, Nevada, I think Florida has like an 18% rate. Texas is up there. In addition, California, you have to be licensed in order to offer products at a higher usury. So really important, obviously, to know what you're talking about, but to make sure that when you enter into a market that you're doing it correctly. So structuring the note, what's the kind of compliance checklist? Well, you want to make sure that your interest rate is admissible given state and federal guidelines. Terms will finance up to 15, 20, and in some cases 25 years, depending on what kind of home it is, where it's located, what's the buyer borrower look like, and what's that monthly payment, in addition to, you know, the outlook of the local economics of the local industry, the area, and things of that nature. Trying to get at least 10% down payment or 5,000, whichever is greater. So if we can have an individual come to the table with more money than they would be putting into First and Last as a rental program, and in addition to that, they're paying $2,000 in prepaid taxes and insurance at closing, that is called skin in the game. SKIN in the game. That means they're financially vested for ownership and ultimately are going to fight to keep their equity in a property, fight to keep their home because they put a sufficient amount of skin in the game. With our paper, we don't have prepayment penalties, no balloon, no prepayment penalty. They can ride that loan for the full maturity. And that's really important to understand because you could get in hot water when putting a balloon on a end user homeowner loan. That's really important. Most people don't know that you need a licensed mortgage officer to do more than, I think, 5 a year. My sister's fiance happens to be a licensed mortgage officer. We were having a drink, and about 4 years ago, kind of mentioned the challenge that we're looking for a licensed mortgage officer, and boom. So she wrote, he's now our RMLO for our transactions. For us to hit scale in the Arizona market, as we go into other markets, we'll have to seek other licensing, like Dan Deppen from Call the Underwriter, or Sohail Badruddin from Provident Loan Servicing. And loan servicing, you know, shout out to Sohail Badruddin at Provident Loan Servicing. We use AFTS, Automatic Funds Transfer Services. That's a contract servicing company. What does that mean? That means we set these contracts up with the note, the collateral, and ultimately onboard it to AFTS, and AFTS extracts monthly payments from the buyer borrower and pays the investor. So they automatically make a funds transfer, say on the 5th of every month, and by the 9th, the investor receives that fund. And if for whatever reason the buyer borrower goes behind on payments, or ultimately needs to talk to someone about form of payment, they can pay with a credit card, they can pay with a bank account, they can send in a certified check. That has nothing to do with the investor. We don't want anything to do with those conversations at the end of the day. So that's why we implement a loan servicing company. The payment for that servicing is actually included in the end user buyer borrower's monthly payment. So the investor isn't paying monthly for that. They do pay a one-time service fee. I think it's like $300.
They pay a one-time setup fee. It's $200. And the awesome part about that, just to piggyback on what you're saying, is if you have the notes set up with AFTS, the investor can look on their account online at any time, and they can see what is the principal balance, how much interest have they earned, when did the borrower make their payment, when was their payment sent to them, what's the status of their escrow, have they kept up their homeowner's insurance, did they pay their taxes. It's a wonderful system, and the borrower pays it in their monthly payments.
Talk about just checks coming in. Obviously, if they go fully non-performing, there's some back office bells and whistles that we provide, but really puts a wall up between the borrower and the lender. Really just want to sit back, put our money to work, and collect a check at the end of the day, and not have the ongoing maintenance expenses, taxes and insurance, potential vacancy risk. Have a required property manager. They're calling you to authorize repairs and things of that nature, or you're actually doing all that yourself and you're getting calls at 2 a.m. That this really eliminates 9 out of 10 of the hardships that people are facing given conventional real estate investment strategies. Non-availability to cash flow, a huge headache or second job, that people maybe have a high income earning W-2 and don't have the time to go out and make sure all of these benchmarks are actually hit at the end of the day. And if it goes vacant, now they're really in trouble. So, very important to keep in mind. So what does an exit look like on a note? As we bring these transactions to the table, why is that so nimble? It is a little different than exiting a single family ownership equation. You can't just go throw it on the MLS and, wait for a buyer. So, option A is obviously to hold that note for the monthly cash flow and above average return received in these note positions. But you could sell a note. You could sell a lump sum for cash, immediately to capitalize or reinvest. You could potentially transfer that note to a family member or whatever it may be, or they buy that transaction for you, or you hypothecate it. Hypothecated is a fancy word for pledging an asset in order to garnish capital investment. You're not taking investment, right? You're pledging a note as collateral in order to garnish the investment, likely at less than what the note yields. So if the note yields, say 50%, or the note yields 10%, if you can borrow at less and feel still risk mitigated, that if that borrower goes non-performing, that you still make those payments to the investor, that you're off to the races. You recaptured capital on a note that is relatively illiquid, and you didn't even have to sell it. It's called earning perpetual returns in a note strategy. You could buy a note today, pull all of your money out tomorrow, and still make a perpetual interest rate on none of your own money. That's quite literally the definition of financial freedom. So how to enter 3 investor exit models, a single note purchase. You could buy a note from $50,000 to $85,000 on these types of transactions. You could participate hypothecated, want to stay away from fractional participation because that could be construed as a securities. Upon origination of a note, you could take on 3 different lenders at origination. right? Because you have now 3 separate agreements on 3 lien positions, and they all took participation at closing of origination of that loan. Very important to differentiate. Or fully securitized through Reg D Silvercrest Opportunity Fund, you become a per unit owner share in our portfolio of notes that we really just went over. And that looks like a 10% return for a 1-year term paid monthly, or 12% for a 3-year term paid quarterly, or you buy one note, one investor, and you make the full yield. We talked about the IRA capability. Most people don't know that this is a qualified product for investors to do 401k rollovers, have a self-directed IRA custodian direct those funds, have a directed IRA, and soon to come, there was an executive order that will allow traditional investment vehicles to invest in alternative assets. That was what's the term? Yeah, it was an executive order. So that they have yet to turn that on. You know, Charles Schwab and Fidelity will ultimately have access to products just like this. I heard Jeff Watson, who's a large private lending attorney, talk recently about that availability, you know, and that came down the pipeline like 6 months ago. He was talking about it a couple of days ago. So they're obviously, you know, gaining traction at the end of the day, and there's billions of money to be had in opportunities for investors to convert their traditional investment vehicle into alternative assets. A lot of people are scared of the big 3. You know, you got BlackRock, Vanguard, State Street. They're becoming almost a monopoly. And how do you get away from market volatility and being subject to potential fiasco? You exit those accounts at the end of the day and get into alternatives that are in senior collateral position paying above average returns. So what is the risk management that we put into place? You know, if someone's placing retirement funds into an investment vehicle, at the end of the day, you want to make sure, obviously, for one, that you're going to get paid, but also, you know, how are we not going to lose any money at the end of the day? There is risk in investment. Quick preface. There's no reward without a risk. But how do we package that ultimately to have the best chance for success? You know, obviously making sure their debt to income ratios are below FHA requirements. FHA will actually go up to 55%. We're trying to be below 50. You know, if we can verify all their car payments, you know, estimate their insurance, estimate their monthly utility bill, and what they're still going to need to actually go and live their life and you know, order food and things of that nature, that's a successful model. Packaging that with professional servicing, making sure there's required insurance policies and the lender is listed on the policy. What if I buy a note and that house burns down? What's the answer to that, Sonny?
We actually require that the borrowers get a year of insurance in advance. And once the note is sold, then I contact the insurance company and I change the lost payee from our company's name to the investor's name so that they are covered under their investment. And while you're interrupted here, we have a message in the chat if you'd like to hear it.
Yeah, let's hear it.
It says, hi, if the property manager handles the maintenance, tenant calls, taxes, insurance, how do the investors usually evaluate whether the monthly cash flow is still worth the investment after those expenses and management fees?
So
I'm not really sure how this relates to what we are talking about, because this is not, we don't have a property manager that handles that. It's the homeowner who handles it.
So really the only fee that is due to a potential investor buying a note is the service contract setup fee. That's $200. And now you're receiving the interest that is attributed to your investment, whether you're buying hypothecated and you make it interest only, negotiated interest rate, or you buy that whole note. Now you're receiving the full yield, where in comparison on a rental strategy, yes, you'd be subject to insurance, maintenance, management, property management, in, you know, fluctuations in taxes. That is all, take all of that, wipe it off the completely off the table, forget about it, and understand that you're owning a note. A note is a mortgage on a house. Most people don't know you can buy a mortgage. You're becoming the bank. Frame that in your understanding. What does the bank do? They write a note with an interest rate, and you make those payments to the bank. Put yourself in that position of Wells Fargo, Chase Bank, and think of just receiving a structured return. It's a structured income play. There's no appreciation. There's no management of that asset. There is some management to a note investment. Obviously, if you're looking for a non-managed asset, that's a fund investment. But hopefully that answered the question.
But to further add to that, it's if you have your, like you said, you have your mortgage with Wells Fargo and you need to replace your roof. You're not calling Wells Fargo to talk about them replacing your roof. It's your responsibility. It's the borrower's responsibility to handle all the maintenance and insurance and taxes, not the investor.
Very important to differentiate. So if there's some operators on this meeting in Florida, Texas, California, and Nevada, on this meeting today, what you're going to do over the next 30 days, ultimately to bring a deal to the platform is week 1, you're going to form your LLC. Week 2, you're going to interview a few RMLOs, call Dan Deppen with Call the Underwriter, tell him I sent you, and set up a servicing relationship where that contract servicer has a license potential if needed in that specific market. Some markets you don't have to have a licensed servicer, some markets you do. You know, that second week, you're going to go visit 10 mobile home parks, maybe place a couple bandit signs, classic guerrilla marketing strategy, or run an advertising on Facebook ads. You could connect your Manus, which is a artificial intelligence application, to your ad account and have it literally do it all for you. Yes, you're going to pay to get those leads at the end of the day, but how are you going to jumpstart a potential new market at the end of the day? Maybe send some mailers to your desired area, but sometimes that doesn't work in mobile home parks. A lot of the times the manager's taking those out of the mail because they're not trying to have another quote unquote flipper in the environment. So week 3, analyze 5 incoming leads, walk 5 properties, and submit 2 written offers. I would say submit 100 offers and find the best one that fits. Because if you make 100 crazy offers, you're bound to find something that actually makes sense. And how do you jumpstart that? Well, you take these steps. Take these steps and go get up off the couch at the end of the day and find deals that make sense. Because when you find deals that make sense, the money follows. It's not in the reverse background of finding money and then going to find deals, because that money is going to go somewhere else if you don't end up finding any deals. Week 4, conduct due diligence, sign closing documents, and fund and record the title. Buy that property, conduct your due diligence, and run that through a data system of comps, of what average rent is and what your exit price is going to be, and ultimately what you have into the property, right? So doing those 5 things will ultimately get you to a successful model, and it may take a few months to get that property sold. So be aware it doesn't just fly off the shelf. But if you hit those benchmarks, a quality property, match or beat market rent, get them underwritten and get them park approved, now you have an investable product. You have a high yield note on one of the most needed asset classes in the entire nation. Your 3 paths forward. You can either build the machine, be an operator in Florida, Texas, California, and have the time, sweat equity, and know-how to go take a high risk component, a fix and flip strategy in an alternative investment, right? And go out and start performing and bring those deals to us when they're packaged and ready. Say, hey, want to sell this note on this home in the next couple months. So what does that look like? Would love to talk about it. Maybe you're too busy to have a second job or a whole job, and you're looking for a passive return. You're finding hardship in traditional real estate investment strategies. That's where you buy a note. So I heard last week that there were some questions as to people like, hey, how do I evaluate on a single family property to own the home and rent it out, or have a note investment that answers its own question. If you're too busy to go and take the necessary education to become a real estate investment specialist, then you probably need to pivot into a less hands-on strategy with still physical collateral and an above average return given adjacent real estate investment strategies. That's a note strategy, buying the output, hitching your cart to a qualified operator, and taking advantage of the assets that are procured in a note strategy. Zero rehab, you could potentially sell that note at any time to anybody, depending on, what your relationships look like, but also your immediate cash flow. 30 days after an acquisition of a note, you start receiving payments, pro forma payments. You come at the top of the capital stack with a bow on it, and in 30 days, you start receiving the payments of the hard work that operators such as us procure out in the market. And say you're not a note investor. Say you're really just looking for a passive return. You want to come in on the top of a stabilized asset with an end user already in the home, whether accredited or non-accredited. You could buy a note hypothecated, right? Which means I pledge an asset in order to garnish capital investment for a 1-year term at an interest-only double-digit interest-bearing contract for a 1-year commitment. And then a year from now, we sit down and say, hey, congratulations, you've been receiving your payments. You knew if it worked or not. Would you like to auto rollover? The note's still performing. Or would you like to liquidate? Maybe you got a daughter going to college, or got a birthday coming up, or whatever it may be. Super nimble in that accord. And how do we provide liquidity to that note? Well, I bring that same note to our investors on the platform and either sell it, pull it into the fund, hypothecate it again, sell a partial. A very nimble when you're at the top of an investment strategy. Yes, if you're a layman, right, and you don't have time to figure that out at the end of the day, that's a hypothecation equation, right? Again, you're pitching your cart to a qualified operator and cash flowing on a physical asset. The third path is for our accredited investment partners. So you become per unit owner share in our pool. We're now making, excuse me, I think it's like $27,000 a month. We just made a few acquisitions. I raised $590,000 in the fund 5 days ago. That adds to about $2 million. That's about $2.5 million. We sold a seasoned note to an investor. I think that's actually on this meeting for $127,000. I think that wire may be in already because it's 152. So, tremendous amount of transactions that we're going through. And these are the notes that are in the fund currently performing at these set interest rates, 20-year terms, fully amortized. I got 1,200, 2,400, 3,000, 41.1, 51.1, 61.2, close to 7,500 just in this little tranche at the end of the day of passive payments, right? That's proof right there for you. So the mobile mailbox money model, at the end of the day, we buy, originate, seller financed, and raise the capital for these notes. We season them and either sell them out of the fund or hold them for long-term cash flow and then repeat. Most people are baffled on why I would sell notes like this. Well, hey, if it was such a good investment, why isn't he holding all the notes? Well, I've got 40 more deals to do. At the end of the day, we've created a system, okay? Think of it that way. This is a system for creating bank quality instruments outside the stock market, outside market fluctuations, and we need more capital to keep the consistent cycle flowing and to enter into these other markets at the end of the day.
We also add to that education, due diligence training, and boots on the ground support.
We're not just a lender at the end of the day. I didn't just go pay $20,000 to start a fund, and I don't know what I'm talking about. We've done over 400 transactions. That's like $40 million in transaction base, from seller finance transactions to raising the capital for these positions. And there's not many other operators in the entire nation that have replicated what we have replicated within this ecosystem. So invest today with Silvercrest Opportunity Fund. You know, we are performing. It looks like we've got 2.1 and 1.97 million deployed. I've got like 400,000 in my account right now that will be going after others. We're netting 8,000 a month. I made 80,000 last year just in the fund. I didn't pull $1 out of that. Why did I do that? Because I'm looking for more stability. At one point, that net is going to make me $250,000 a year, right? And I'm not pulling in a profit currently, and just continuing to snowball until I pull a fat check out after making my investor payments of $22,000 a month with no fluctuations in investor payments. So this is how you scale. This is how you scale a model in a time when it's needed most, in the most needed asset class in the entire nation. If every news source in the nation is quoting affordable housing as a problem and no one's looking into manufactured housing, that's a problem. So I'm looking to talk to the president potentially to have a government-backed financing component as we enter into these other markets, talk to other operators, and continue adding to our 400 total transaction base and over 200 notes we've created. Again, if you're in Arizona, Texas, Florida, California, and wanting to participate, we have a new platform that is actually already created with National Mobile Homes at mobilehomes.me.com, mobilehomesnearme.com, where this system will ultimately help facilitate almost like an MLS for manufactured housing. Most people don't know that there's no MLS for mobile homes. Mobile Home Village was a big platform for a long time, and then Carlisle Group actually bought Mobile Home Village, and now most people don't use it because they provide pref to their inventory. Currently, it's just our homes on the website, but this gives you a view of what to actually do as an operator, a potential buyer, and a potential investor. How to get pre-qualified as a buyer. Maybe you have a buyer that you're wanting to package a note for. This will walk you through the entire process. You know, you could join our performing note inventory as we implement the strategy in other markets, and it gives you a step-by-step process of how to acquire, rehab, verify and list, underwrite the borrower, close and service, sell the note. Why is this so important? Because nobody's doing this in manufactured housing and providing a ability to sell or finance the home and exit that home vertically integrated through a note, and the necessary updates that are required in order to risk mitigate that specific property. So that's National Mobile Homes, mobilehomesnearme.com. That'll be launching with our new potential partnership. Me and James were approached about coming into the Florida market. So that is to be continued. For this last portion of the meeting, we're going to talk about the couple notes that we have coming down the pipeline. Lot 195, this buyer borrower had a judgment from the previous landlord, but I'm told they're paying it today and getting verification. Once that's done, they will actually formally be approved by the park, from what I understand. They got a conditional approval from the community, and they are facilitating that today and submitting for Dodd-Frank compliance. Let me just pull up my notes here. Give me 1 second. This is lot 195. We've been talking about this for a couple weeks, and I think it's going to sell here in the next couple days. Our 4-bedroom, 2-bath. I partnered with this home with the local roofing and construction company, where they helped me rehab the property. This is lot 195. And a new note potentially coming to the table. Bear with me here. My notes are all disoriented.
At $135,000 with $10,000 down, the payment is $1,645.99.
$1,645.99. If we don't find an investor for this property here in the next week, obviously pending due diligence, pending underwriting, pending you taking a look at it, this will get absorbed into the fund. I feel very confident that transaction is going to take place on this home. And the fruits of our labor, with tile, backsplash, granite, new cabinets, updated electrical and plumbing, new roof, new siding, new paint, flooring, plumbing, all the above, new windows. Actually, we didn't do new windows on this property. Packaged, fully packaged as a bow of real estate investment strategy in one of the top 5 markets in the nation. That's lot 195. If that note is of interest to you right now, put your email and the lot number, lot 195, in the chat, and we'll send you an update as this comes down the pipeline. That's in Sierra Estates Mobile Home Park. Let's see if I can get around this window here. Lot 38. Lot 38, we've been talking about again for the past 2 weeks. We have a buyer contracted for this property. They're doing their final walkthrough today, going through their formal underwriting process and getting risk mitigated. So these are the pre-rehab photos, and we'll go into the current rehab photos. Lot 38. At $85,000, they got a discount because they took a bite at the property prior to us even being finished. So they're going to pay $85,000 with a potential $5,000 down payment pending underwriting and things of that nature. They seem pretty confident that they're going to hit those benchmarks for a 20-year term at an $80,000 unpaid balance, or in other words, you're buying a note on a property like this, right? This is the pre-rehab photos. We'll get to the post here in a second. At $994.82 a month. So for $80,000 with no maintenance, management, insurance, taxes, hardship in figuring out why your renter's calling you or whatever it may be, at $80,000, you acquire this note on the property that we rehabbed and make $994 a month, 82, lot 38 in Casa de Francisco. I think we've done like 5 homes in this park and maybe 10 across the street. But here's the current rehab photos. We've busted out all the tile. We were talking about trying to keep it and go on top. We went away with that. And now laminate flooring, updated electrical and plumbing. We've got new windows on this home, actually. I need to get some updated photos on this property as we actually close the home. And here's the cabinets that we're putting in. So, fully refurbished in this home. This is in the South Mountain Market with new vanities and things of that nature. Oh, my screen's getting a little wonky here. Bear with me. So someone tried to come in and bust up the meeting, looks like. We're getting a fair amount of transaction, but that's what we do here with Mobile Mailbox Money. We do this weekly, every week at 1 o'clock Arizona time, and we sell notes for a bow of real estate investment. That's how you do it in creative finance. At the end of the day, we got 4 people still watching. Shout out to the loser who joined our meeting today. We're obviously gaining a tremendous amount of transactions and velocity. People are starting to kind of understand what's going on the opportunities that are available. So much so, someone took some time out of their day to come and join our meeting and try and cause a ruckus. So, that's one step closer to financial freedom. We call that Mobile Mailbox Money. We'll see you next week. Appreciate it.